The IRS already knows more about your retirement income than you think. And after 65, the gap between what they know and what you report is exactly where audits are born. This video covers 3 specific areas where seniors consistently trigger IRS red flags, not because they are dishonest, but because they do not know where the lines are drawn. I am going to walk through each one in plain language, show you the real dollar costs, and tell you exactly what to do differently. Here's what most people do not understand about how the IRS works. It is not a room full of agents reading your return line by line. It is a computer system running automated matching programs. Every W-2, every 1099, every brokerage statement, every pension payment, those go directly to the IRS from the payer. Before your return even reaches a human being, the system has already compared what you reported against what it was told you received. This system is why retirees are disproportionately flagged. After 65, your income sources multiply. Social Security, pension payments, IRA and 401k distributions, required minimum distributions, investment dividends and interest, maybe rental income. Each one of those sources generates a separate reporting form that lands at the IRS, and each one is a separate opportunity for a mismatch. The more income streams you have, the more chances the computer has to catch a discrepancy. Working people typically have 1 or 2 forms to reconcile, a W-2 and maybe a brokerage statement. Retirees can easily have 6 or 8, and the automated system treats every single one of them as a checkpoint. This is the most common trigger for seniors, and it catches people who are not trying to cheat. They forget a small IRA distribution. They misread which portion of their Social Security is taxable. They enter a pension amount from memory instead of from the form. Any of those moves creates a mismatch, and the computer does not care why it happened. Let me give you a real example. A 66-year-old widow handled her own taxes after her husband passed. She was careful. But her late husband had a pension, and the 1099-R that year reflected a payment made before he died. She reported a slightly different number, not out of dishonesty, but confusion about which amount applied to which year. The IRS sent a letter. Back taxes. Interest. The planned vacation fund was gone. That is not an edge case. That is a pattern. And the dollar cost is not abstract. If you misreport a $30,000 IRA distribution, the back taxes, interest, and accuracy penalties can easily run $3,000 to $6,000 on top of what you originally owed. That is real money for a retiree on a fixed income. Social Security is its own category of confusion. Not all of it is taxable, but some of it almost certainly is, depending on your combined income. The IRS calls it provisional income. Add your adjusted gross income plus non-taxable interest plus half of your Social Security benefit. If that number exceeds certain thresholds, up to 85% of your Social Security becomes taxable. Most people know this in a vague way. Far fewer people calculate it correctly every year as their income mix shifts. The fix here is straightforward, but it requires discipline. Wait for every single form before you file. Every 1099-R, every SSA-1099, every 1099-DIV, and 1099-INT from every account. Seniors who file early, before all the forms arrive, are the ones most likely to create a mismatch they do not even realize they made. One missing 1099 from a brokerage account, even a small one, a few $100s of dividends, is enough to kick off a notice. And notices, left unresolved, can escalate quickly. Required minimum distributions are one of the clearest examples of a rule that sounds straightforward but catches an enormous number of retirees every year. The government requires you to start pulling money out of your traditional IRA or employer retirement plan once you reach the applicable age. The logic is simple. The government gave you a tax deferral on the way in, and now it wants its share on the way out. You do not get to leave that money untouched indefinitely. Miss that distribution or take less than required, and the penalty is severe. Up to 25% of the amount you should have withdrawn. On a required distribution of $20,000, that is a $5,000 penalty for a single year. And that sits on top of the ordinary income tax you still owe on the amount once you do take it. A 72-year-old retiree, confused about when exactly his RMD requirement kicked in, skipped his first distribution. He assumed he had more time. The IRS disagreed. The penalty he paid wiped out more than a month of Social Security benefits. One missed withdrawal. That is what 1 year of confusion cost him. Congress temporarily waived RMDs in 2020, and that created a false sense of comfort for some retirees. They got used to skipping the distribution without consequences. That waiver is gone. The IRS is now watching RMD compliance closely in the years that followed, specifically because non-compliance spiked during and after the waiver period. The second way RMDs go wrong is not the skipping, it is the math. The required distribution is calculated using your account balance as of December 31st of the prior year, divided by a life expectancy factor from IRS tables. That calculation changes every year. The balance changes. The factor changes. Retirees who use the prior year's number, or who estimate instead of calculating precisely, often under-withdraw. The IRS knows the correct number because it receives account balance data from custodians. The third RMD mistake is the one most people never see coming: multiple accounts. If you have more than one traditional IRA, you can aggregate the RMDs and take the total from any one of them. But if you have a 401k from a former employer still sitting in that plan, the RMD for that account must come from that specific account. You cannot satisfy it with an IRA withdrawal. Retirees who consolidate in their heads but not on paper get this wrong constantly. The solution is not complicated, but it requires you to be methodical every single year. Pull your December 31st balance from every traditional retirement account. Apply the correct IRS life expectancy factor for your current age. Calculate separately for any employer plan still in a 401k. Then, take the distributions before the deadline. Document every step. One distribution done right is all it takes to stay clean. One distribution done wrong is all it takes to owe thousands in penalties before the tax bill even starts. This is the red flag that catches the most well-intentioned retirees. They are not fabricating deductions. They genuinely gave to their church. They genuinely paid medical bills. They genuinely lost money on a rental. But the way those deductions were claimed, the amounts, the documentation, the classification, those are what trigger the flag. Here is how the IRS thinks about it. The system does not just check your return against your own income forms. It checks your deductions against a statistical average for people at your income level. If you are a retiree reporting $45,000 of income and you are claiming $22,000 in charitable deductions, the computer notices. Not because that combination is impossible, but because it is statistically unusual. And statistically unusual is exactly what the algorithm is designed to find. Medical expenses are the first place this plays out. You can only deduct unreimbursed medical and dental expenses that exceed a set percentage of your adjusted gross income. The IRS checks whether the expenses are actually qualified, whether they were actually unreimbursed, and whether you have documentation to prove it. Misclassifying $10,000 of non-qualifying costs as medical expenses can erase the entire deduction on audit. You lose the whole thing, not just the portion that was wrong. And you still owe back taxes, interest, and possibly an accuracy penalty on top. Charitable deductions are where the stakes get even higher. A 68-year-old couple who donated consistently to their church, real money, genuine generosity, found themselves facing a disallowance notice. The reason was simple. They had no written acknowledgement from the organization for donations over $250. The church was legitimate, the donations were real. But the IRS does not accept your word or your memory. The deduction was gone. For cash donations above $250 to any single organization, you need a written acknowledgement from that organization. For non-cash donations of property over $5,000, you generally need a qualified independent appraisal. Seniors who donate appreciated property without getting that appraisal lose deductions that might have saved them $1,000 or more in taxes. Rental losses are the third piece of this red flag. The passive activity rules are what catch most retirees here. Rental real estate losses are generally considered passive. If your adjusted gross income exceeds $100,000, the ability to deduct rental losses against other income starts phasing out. Above $150,000, those losses are fully suspended until you sell the property or generate passive income to offset them. The hobby loss rule adds another layer. If your rental or side activity has not shown a profit in at least 3 of the last 5 years, the IRS has grounds to reclassify it as a hobby. Once it is a hobby, the losses disappear entirely. There is a pattern running through all 3 of these deduction categories. The deduction itself is usually legitimate. The activity was real. The money was spent. What goes wrong is the documentation, the classification, or the math against the threshold. The retirees who stay clean do one thing consistently. They treat documentation as part of the transaction, not an afterthought. The receipt goes in the folder the same day. The acknowledgement letter from the charity gets filed before tax season. The rental income and expense ledger stays current month by month. Here is where this all lands. 3 behaviors consistently put seniors in the IRS's automated crosshairs after 65. Misreported or omitted retirement income, RMDs done wrong, and deductions that stand out against your income level. None of them require dishonest intent to trigger a flag. All of them are preventable with the right habits in place before you file. Wait for every income form before you file. Calculate your RMD from the actual December 31st balance and the correct IRS table, every year, not once. Document every deduction at the time of the transaction, not when a notice arrives. And match every number on your return to the source document it came from. If you found this useful, there is a new video on this channel every day covering retirement income, Social Security, Medicare, and the tax rules that affect your money after 65. Hit subscribe so you do not miss one.